Now we're going to move on and talk about interest rates. Now for liabilities, it's the additional amount you will pay to a lending institution to borrow money. Now in terms of saving, interest is the additional amount that you will earn for having your money in a bank account or other savings vehicle. Now since this unit is on credit, we're going to be focusing on the first definition. It's the additional amount you'll pay to a lending institution to borrow money. Now, interest rates vary from one credit facility to another. So, for example, on average, a mortgage can be anything from 3 to 8%. And in something like a credit card, the average interest rate now in Canada is 25%. So it varies from which credit facility and, the institution you're borrowing from. And, there's definitely many different scenarios where interest rates can be lower and higher. Also, we want to make this super clear. We don't want to mix up the different types of interest for liabilities. So, interest for credit cards is going to be the first definition. The additional money you'll pay to a lending institution to borrow money, and then interest for assets like a savings account, the money you can actually earn for putting money into someone else's saving vehicle. We do not want to mix these up at all. Now we'll quickly cut to a video that goes more in depth on interest rates.
So you dating anybody now, or what's going on?
Not really. I'm not getting hits on any of my dating profiles, not even the weird ones. Must just be a bad time for interest rates.
Interest rates. I see what you did there.
What?
You joke. Interest rates, like on a credit card or something? I mean, it wasn't that funny, but,
Stop changing the subject, dude. I'm talking about online dating, not credit cards. Keep up. What I would give to swipe left on our friendship.
Maybe you owe him an apology. The phrase interest rates can refer to a lot of things, but people generally don't use it to talk about their dating lives. Every loan comes with interest, a set amount of money that's added on to the final loan amount as a surcharge for borrowing. Now, how much you pay in interest depends on your interest rate, a prearranged percentage of the loan amount. Not all interest rates are the same, though. There are interest rates on savings products like CDs and savings accounts, interest rates on consumer loans called APR, and then interest rates set by the Federal Reserve, like the ones you hear about on the news. Let's sort them all out. Certain methods of saving allow your money to collect interest. Yes, the bank pays you. These days, a great savings account will pay you somewhere around 1% in interest. Most rates are lower, however, and your personal number can vary based on factors like minimum deposit. For CDs, the high end is just under 2.5%, higher because with CDs, you aren't allowed to withdraw your money whenever you want. APR stands for annual percentage rate, and it's the most widely accepted way to talk about consumer interest rates. APR is paid to a lender so that you can borrow large amounts of money, typically to buy a car, house, or even use a credit card. And they tend to range from 4 to 25% depending on your credit. As the term implies, your APR determines how much interest you'll pay per year. However, that percentage is often split into monthly installments, so 12% APR becomes 1% per month. The final kind of interest rate is the federal funds rate. You won't see this rate in your everyday life, but on a macroeconomic scale, it's a major indicator of our economy's health. We'll cover this more in a separate video, but Fed rates determine how much interest a bank has to pay if it needs to borrow money. Yes, even banks borrow money. Fed rates have been at historic lows since 2008 in an effort to combat the financial crisis. But now that the economy has shown signs of recovery, they're set to go up. Like I said though, more on this later. That's all you need to know. I hope you found this interesting? Really? No, that's terrible. I'm not saying that line. Anyway, till next time.
Now we're going to go over credit facilities, and more specifically, we're going to be going over credit cards. So for credit, it's the amount of money a creditor is willing to loan in order to purchase goods and services. Now, the most common types are Visa, MasterCard, and American Express, but the two biggest in the world are Visa and MasterCard. Now, there are no transaction limits, whereas you can be restricted with the amount of times you can use your checkings account. So, for example, we went over in the banking unit that there are limited transaction accounts. You may only be able to use your debit card 5 to 25 times a month. Now, the credit card, this is not a thing. You just can't go over your credit limits. So let's say you have a $1,000 limit on your credit card. You could use it 1,000 times for 1,000 purchase of $1. But let's say you have $1,000 in your limited transactions account, 5 transactions. You can only use 5 transactions. So let's say you did 5 of transaction of $1 each, you can only spend those $5, and then the rest of your account, unless if you want to continue to use it, you're gonna have to pay for that privilege. Now, you can be automatically eligible for a $1,000 credit card if you're new to credit. Now, this is on average. When I was getting my credit card 2 years ago, it was only $500. So now they've added $500 to this. Now, as I kind of said, this is the average, so this can be higher or lower. And with credit cards come extremely high interest rates. We're talking about the average right now is 24 to 26%. So if you put $100 on a credit card, you don't pay it off, that next month, let's say it's 24% interest rate, you're paying a quarter of that amount in interest. So you'd have to pay back $124, but you only borrowed $100. So those are, some of the problems with credit cards. You can, fall into a deep hole quickly because of this extremely high interest. Now we'll cut to a quick video that explains more about credit cards. Now we're going to continue on with some more credit facilities. We'll go over line of credit, an available amount of credit to borrow if needed that can be used at any time, paid back at any time. These are extremely useful for, let's say you have a sudden car repair or the roof of your house needs repair. They're good for like larger costs that are sudden and we don't necessarily plan for. Now, it can be used for time emergencies. Now, they're going to have a lower interest rate than a credit card. Then one of the most popular ones are going to be a car loan, lending of money from one individual organization or entity to another individual organization or entity. Now, regular set of payments over a fixed period of time. Now, with this fixed period of time, it's usually anything from like 5 to 12 years. Now, lastly, we're going to go over overdraft protection. It allows your checking account to go into the negative when you don't necessarily have enough funds available. And we're going to have student loans, which can be extremely popular for those just graduating high school and could be trying to further pursue their education. Now, student loan is a repayable loan that is interest-free while in school. Now, in British Columbia, the BC student loans are actually interest-free now, but the Canada-wide ones are not interest-free. And if you get any private loans, whether it's through a bank or another institution, there will be an interest on that. Now, we're going to compare payday loans versus ordinary loans. Now, a payday loan, aka a check loan or a cash advance, is usually short-term, around 30 days, but it can be as short as 5 to 7 days. They carry huge fees. Now, as we were saying earlier with a credit card, pretty high fees at 25%. You borrow $100, you have to pay back $100 plus $25 from that 25% interest rate. Now, these have insane ones, 400% interest rate. Imagine borrowing $100. That's math we don't want to do for that 400%. Now, these loans are also unsecured, meaning there's no collateral or assets to back up this loan. So unlike a car loan, if you fall behind on your payments, they'll just take your car away and then your debt's essentially done from there. Now with this, if you don't make your payments back, they will be harassing you, calling you, emailing you every single day to pay that back because they don't have any security or collateral to get from you. Now, 80% of loans are renewed, resulting in most borrowers paying more in fees and interest than they borrowed. So this is the unfortunate part. Some people get one loan out for January, then for February they get another loan, not necessarily because they need that money to, buy groceries or rent. They just need that money to pay off the first loan. And this can kind of become a never-ending cycle of, falling behind on, your loans. Now, when we compare it to ordinary loans, typically an ordinary loan, you're going to have a longer term, like 2 to 7 years. The fees are going to be quite a bit less with interest rates varying from 4 to 36%. But one similarity is many of them are also going to be unsecured, meaning there's no collateral or assets to back up this loan. Now we're going to go over credit score. Now, a credit score is a numerical expression based on the level of analysis of a person's credit files to represent their creditworthiness of an individual. Now, generally a score is between 300 and 900. Now, what actually affects your credit score? Now, bill payments are the largest influence on your credit score. So these are things like credit card statements, loans, mortgage payments, anything like that. So it's super important that you keep on top of all these payments, pay them on time, even before if you can. Now with these, bill payments we're talking about, these also include utility and service payments, such as your cell phone bill. So if you do fall behind on something like your cell phone bill, it can negatively affect your credit score. Now, a lot of people do say a credit score is more important than the bank balance in your account. Now, this is due to leverage. You can have $1 million in your bank account, but with that $1 million, you can't go out and buy $10 million worth of real estate if you have a bad credit score. If a good credit score, it just increases your leverage. You're able to apply for loans to get cars, houses, many things like that. Also, the cost of borrowing is a lot less because of your high credit score. The lower the credit score, the more expensive it is to buy something like a house or a car. Let's say you're at a scale from 360 to 550. If you do apply for a mortgage or a car, if you do get approved, it's going to be very expensive. But a lot of the time, you might just get rejected. Now, if you're 700 and above, you're going to be in a good credit standing, so you're going to get approved for most loans, and typically you're going to have a pretty low interest rate. We'll quickly move into a video that's going to further explain credit score and different elements that add up to actually create your final score.
What are you going to order? I'm thinking tacos.
Hey, have you checked your credit score recently?
What, you think I can't afford tacos?
No, I was just curious.
Oh, well, yeah, I have checked it recently, and I got like 100, which my guy says it's one of the highest scores he's ever seen. So, Taco Tuesday, here I come. What, you don't like tacos or something?
No, your guy? Come on. Everyone knows that the highest credit score that you can get is 1,000.
That's what I meant. I messed up the words. It was a flub. When I said 100, I just forgot the other 0. Different word. 1,000 credits is what I meant to say. Totally got 1,000 credits.
Okay, so to be clear, credit scores don't go up to 1,000. The scale runs from 300 to 850. And while I'm at it, there are a few other things you should know too. A credit score is a portrait of someone's credit history, made up of several factors that we'll cover in a moment. This number is placed on a scale that helps prospective lenders evaluate how likely you are to pay your debts. This in turn determines what kinds of loans you can get. There are 5 factors that determine your score, and they all have varying levels of importance. Payment history is the most important piece of your credit profile, and it accounts for roughly 35% of your score. Makes sense, too. If you've been responsible in the past, you can probably be trusted in the future. So avoid late payments at all costs. Amounts owed, or credit utilization, is the second most important factor, coming in at about 30% of your score. Now, this part is important because notching a good credit score doesn't mean that you don't borrow. In fact, not using your credit is almost worse than using tons of it. You want to show that you can handle a reasonable amount of debt without going off the rails. One of the more obvious factors in a credit score is the length of your credit history, which counts for 15% of your number. It's like in those old movies where a shop owner lets one of his regulars run up a tab because he knows he's good for it. Same goes with credit. The longer you've been borrowing, the better. Finally, types of credit and new credit each account for 10%. Types of credit reviews how many sources of borrowing you use, like a car loan, mortgage, and credit card. The more diverse, the better. New credit takes into account how often you take on credit you don't need, like applying for a credit card at 5 of your favorite new stores. So while you can't have a credit score of 1,000, you can make sure you're taking the right steps toward a great credit score. Come to think of it, I think tacos do sound pretty good right about now.
Now we're going to go over credit checks. Now, a credit check is a request to view your credit history and is used to establish how much a credit institution is willing to loan you. Now, too many can negatively impact your score. Now, there's 2 types of credit checks. Number 1 is a soft inquiry, and number 2 is a hard inquiry. So a soft inquiry is just going on, creditkarma.com or looking at your credit score through the online banking app. Now, you can check this 100 times a day. It will never affect your credit score. But a hard inquiry is when a third party looks at your credit score. So this can happen when you're applying for a mortgage, applying for a car loan, trying to get a new credit card, because all these institutions need to look at your credit score to see if you're worthy enough or you're reliable enough to actually take out this loan, and it helps determine the interest rate. So too many hard inquiries will lower your credit score. So let's say you're going to go buy a house. A year or 2 before, try not to buy a car or take out any new credit cards, because those will lower your score. And when it comes to getting your house 2 years later, you might get denied for a mortgage, and if you do get approved, you're most likely going to be paying quite a bit higher interest rate. It's just kind of a quick tip. These are kind of just like a quick tip on how to save money on, mortgage, car loans by simply, being aware of your credit checks.